back to the crypto market updates channel. It's the 27th of October, early morning. This video is going to be a quick recap of what's been happening in crypto over the past little while, the past week, and also what's happening in DeFi. First thing we're going to do is jump into the markets here. Have a look in CoinGecko. Got a market cap of 1.3 trillion. Bitcoin above $34,000, which is nice to see. Ethereum has been going through a nice pump in the green. Binance Coin, XRP, USDC, Lido, Staked Ether, Solana, Dogecoin, Cardano, all in green. Everything is in green today except for the stable coins, which fluctuate obviously, so they keep the market at bay. But other than that, literally everything is green. It almost looks like the bull market is upon us. It's just on the verge. Bitcoin is broken above 31,000 here, which was a resistance in the past, and it closed above that line on the daily chart. On the weekly chart, it's still has 3 days to do its thing, but I guess presumably it will not go back down below 31,000, so we should see another candle within 3 days opening up above this level, so that's nice. Come across this article that says staking crypto yields hit historic low as proof of stake networks see rising stake rates. What's going on? The thing with staking is that I guess it was meant to be a way to move money away from banks and into the Web3, into DeFi, decentralized finance. And so a lot of money was moved into DeFi. A lot of people obviously jumped right onto the opportunity simply because the returns on DeFi were so enormous, they were so juicy that people were choosing DeFi over traditional banking, which wasn't paying that much in yield. However, if this were to disintegrate, if this were to change, if DeFi all of a sudden stopped being as lucrative as it used to be, or as lucrative as banks, then perhaps a lot more people might be dissuaded from using DeFi in the future. Declining staking yields and rising stake rates stir questions about the long-term validity of staking crypto. One additional thing about staking is that it's a way of securing the blockchains and supporting the cryptocurrency system or sphere. And so that kind of requires a leap of faith on the part of the people who are involved in it. If you do not believe in the technology, then you simply will not be interested in what it has to offer, and you will not be willing to invest and stake your money if the return aren't as good as in a traditional banking system. As proof of stake networks see a surge in stake rates, a consequent plummet in staking yields is concerning investors and market watchers, according to third quarter report Staked, a subsidiary of the Kraken exchange. The average staking yield of the top 35 stakeable cryptocurrencies has dwindled to a record-breaking low. The average staking yield across proof-of-stake networks has sagged to a meager 10.2%, which actually is a very good return when you consider the fact that banks don't come anywhere close to it. In the past, they were paying even less. I think right now I pulled up some statistics I will go over in a second that show that banks now pay a little bit more. Ethereum, the largest network that employs proof of stake, displayed a particularly noticeable drop. Its consensus layer yield sank to 3.2%. Now, if that is the return that Ethereum is offering, that is certainly a lot lower than what banks are offering. So if you were going to if you were looking for simple gains, then if you're an investor, you might want to question the necessity of having to go through the trouble of getting your money onto the internet, getting it onto the blockchain, and staking it through Ethereum, with Ethereum, through whatever provider is providing the yield, versus simply going into a bank and depositing your money there for possibly for a higher return. So for this to be valid, or for this to be acceptable, a person needs to be a believer in cryptocurrencies and a believer in blockchain in order to understand the need for the blockchain to exist and to be secured with the liquidity or with the staking power that is provided by the investors' money. Now, if people are not interested in the tech, if they don't care about it, then they will most likely go to banks. BankTrade has a list of best savings accounts for October 2023. So let's have a look here. This is on savings, 4.6% at Sophie, 5.10% at BMO Alto, 4.5% at Lending Club. Savings Club has 4.3%, and Laurel Road 5%, and Money Market 5%. And there's no requirement for a minimum balance. This is on savings accounts, the accounts that used to pay essentially peanuts for returns, but now they are paying, percentages that are higher than 3.2%. Popular Direct, there's a minimal balance required, $100, which is not a very huge amount, not a big amount. Rio Direct, $535 with a $5,000 minimum in a bank account. So most of these are above 5% return, which is great, except for Chase and Bank of America, who still offer peanuts. Barclays, 4.35, minimum, zero balance. So right now banks are offering a return that comes very close, that is in tight competition with DeFi incentives, which makes the need for people having to learn how to operate on centralized finance questionable. A lot of people are not really willing to sacrifice the comfort that comes from using banks and simply walking into a bank and handing over your money. And the idea of banks trying to control the financial system and all the conspiracy or theory approaches might not necessarily work, because banks have been around for a very long time and they've functioned very well so far, despite the fact that yes, they make millions of dollars off of our backs from interest rates and this and that, but it's a system that has been functioning and it's very difficult for people to understand that it needs changing. So when you have return rates like 3.2% on ETH, or things that are as low as 4.5, it begs the question whether it's actually worth it, because it does come with a learning curve that everybody needs to go through in order to understand how to deposit money onto the blockchain and into any particular service provider that offers yields on staking. Not everybody, the majority of people out there are not willing to do that. Most people seek comfort. People with regular jobs are a lot more inclined to simply take a path of ease and go into a bank and, like I said, hand over their cash, rather than having to try to figure out how to navigate the blockchain and the plethora of providers and scams that are available. In addition, you have to worry about security, which also makes it more difficult. And which makes banks a lot more welcoming in that sense, because we don't have to worry about security as much. Forbes Advisor released an article here, best crypto staking platforms of 2023, and there are literally just three: Robinhood, Gemini, KuCoin, Coinbase, Binance. But what the staking rewards are, we don't know. Right now, if you go on Binance, for example, and you go into simple staking and you go into DeFi staking, for example, you will see percentages like 19% on Curve or Convex. These percentages obviously vary, and the thing is, they have quotas, so you can't really stake it for very long. There are quotas on how many tokens you can stake. For example, total personal quota is 4,000 CVX. Now, I don't know how much CVX is, but let's say CVX is $1, which means that I can stake $4,000 for a duration of 120 days at a percentage of 19.8%, which is not a lot, really. If you do have, for example, $20,000 sitting around and you want to invest that money for return, it really doesn't give you that percentage. You'd probably be better off going to a bank and depositing that money for a year for 4.5%. You will probably get the same return as having it sitting for here, the 4,000 for only 19%. If you continue scrolling down through all the other ones, flexible lock, the flexible lock is always a little bit lower, has a lower return rate because you can stake it and take it out at any time. So if you notice, it's 0.7%, 1.4 on USDT, Ethereum 1% on the flexible, and Venus 5.8%. And most of there's DAI for 5 and Bitcoin 0.2% on Bitcoin, which is minuscule. DOT offers 15% here on flexible savings, and again, these things have quotas. So DOT available quota is 1,000 quota. It depends on the account, so depending on, I guess, maybe the amount of trades that you conduct on Binance, but it's all conditional. It's not 100% open and free for anybody. And if you notice, the returns here are quite slim. This is on the flexible. Most of this is flexible staking. You can receive better returns on longer investment plans. So if you have a lockup period for 30, 60, 90 days, then you receive a higher return rate. Obviously DOT has 15, but again, these plans have quotas, so you will not be able to for example, lock up more than 1,000 DOT at one point for a 15.9%. You lock up 1,000 DOT for about 4 or 5 months, then you will receive 52 DOT back, which, depending on how well DOT does in the upcoming bull market, the dollar value of these 52 DOT will vary, obviously. Right now DOT is at $4, I think, trading. It was below $4 just a little while ago. If it manages to get back up to $52, then I bet that this will probably change. You will not be able to look up 1,000 DOT anymore anyway. So there are a lot of conditions in the DeFi space and in the banking space, and if things continue to decline, if things continue to disintegrate the way they have been here in terms of return rates for DeFi staking, the worthiness of staking may be put under question. So best thing to do is start mining your own crypto if you can. Maybe take that money, buy some GPUs and start mining some crypto, because proof of work is the real incentive and the real build of value, creation of value in any coin, which is why Bitcoin is rallying as much as it has been, why Bitcoin is king, and why coins like Meow Coin are of value, and Litecoin and Monero, for example, because they require proof of work. There needs to be work conducted in order for these coins to be out and about, versus those that have been just printed at the press of a button and distributed amongst thousands of people. So what the future of DeFi is, I have no idea. I just watched a video by Elo Trades, who is talking about the gaming industry, and he swears, just like Becker, they both swear by gaming industry, which I could see exploding, because gaming is huge and it has been used for over a decade right now, and people continue to and will continue to use play games and use the tokens that are inside the games in order to get their NFTs and get their avatars and gaming tokens that you can use to purchase different upgrades and stuff like that. So yeah, these are certainly definitely use case scenarios that will be here and have been here and will continue to be here. But when it comes to DeFi and staking, we'll see what happens. It might just turn out to be for those who are already in crypto, and not so much for newcomers. People may not be persuaded to jump onto crypto simply in order to engage with DeFi if traditional banks provide better returns, but let's wait and see. Bull run is coming and everything is green, so that's great. Make sure to smash up the likes on this video, subscribe to the channel, and I'll see you in the next video. Bye-bye.